Welcome back. I told you it was going to be a quick respite. I just went and took a nap for about 5 seconds and I'm back. All right, so let's do some exhilarating accounting for bank loans. Let's see, I could either ride the zip line or account for bank loans. I'm such a nerd. I'm not interested in the zip line. I could fall off that zip line, or I could break that zip line because I weigh too much. I don't think accounting for bank loans will get me into trouble. We'll see. All right, so most companies account for assets using historic cost, okay? But this method does not work for loans because it does not present an accurate picture of the value of loans. So let's talk about what happens to loans, okay? Loans are systematically paid off through regular payments over time, okay? So because of this, the proper way to account for their value is to amortize them. In other words, if you make $1 million loan to someone as a bank, and it's a 10-year loan, 5 years later, probably about 30% of that loan the principal value will have been reduced, so it is not accurate to keep that loan on the balance sheet at the original amount that was loaned. You have to amortize those loans. Let's see what we got here. All right. So that just makes sense. All right. Miscellaneous assets at banks, the premises, the buildings, the nice buildings that banks have. And I would just say this, when you see a building that has a name on it, the Simmons Bank building, Simmons may or may not own that building, okay? But one thing is certain, Simmons owns the naming rights to that building. Now Simmons might own that building, or Simmons might not even be the largest occupant of space in that building. Just because the name is on the side of the building doesn't mean Simmons owns the building. So that's the case with all buildings, so keep that in mind. So these are headquarters, branches, the furniture and equipment, other assets, other real estate owned, OREO, other real estate owned, okay? This is the real estate the bank has received as collateral on loans that have become non-performing. So yes, the bank will foreclose, they will take the asset, and that goes on the bank's balance sheet. They have to write off the loan, but now they have what's called other real estate owned. Okay? And this process of legally taking control of an asset is called foreclosure. All right? So banks will typically sell collateral that they receive through foreclosure. Remember, the banks are not in the business of owning and managing real estate. Some of them have gotten into that. But typically when they get these assets, they want to sell them. Okay? And again, this is part of the problem that we had back in 2009. All this real estate hit the market at the same time. Banks had to write off loans, and then they received collateral, and then they had to sell this collateral all at the same time, and so market values just kept going farther and farther down. Okay? All right, then you have goodwill and intangible assets. All right, what is goodwill? You've gone over this in accounting. Goodwill is created when one company buys another company and pays more than the market value of the company's assets. Okay? So it has to go down on the balance sheet so that the balance sheet will balance. Other assets for a bank include what's called servicing rights. Okay? And this is when banks have the right to collect and to account for loans or credit cards. So banks charge fees to collect loans and credit cards. They may not even own the loans, but they have the rights to collect the loans. Okay? And so it's an asset, and it's called servicing. All right. So let's take a closer look at the balance sheets for banks. and we're going to look at them in terms of the percentage of total assets for all banks, then for smaller banks, mid-sized banks, and large banks. Okay? So you can see that about 9% of assets are held in cash at the small banks, as low as 6.5% at mid-sized banks. So there's a big spread there. Then in terms of securities, you can see once again the smaller banks hold more, so they hold more cash and they hold more securities. So they look a little more conservative. Okay? And then Fed funds, now we're going all the way down to, because Fed funds is not that important, we go down to loans. And you can see that the mid-sized banks hold the largest percentage of their assets in loans. So this is the sweet spot for lending. About 66% of their assets are in loans, compared with 51% for the very large banks, because they do a lot more security investment. And you can see the loan loss allowance at, let me get back here, there you go, at 1% for small banks, all the way up to 1.9% for large banks. And that's because large banks make large loans, okay? Larger and riskier loans. And you can see trading account assets only at the large banks. Okay? And then you can see that bank buildings, look at there. Banks have really nice buildings, but they don't account for much of their assets. Okay? Whoops. All right, so those are the biggies. Loans, securities, and cash. And you can see that the loan loss allowance is between 1% and 2% basically. Okay? So when you look at this at 1% to 2%, and you think about what happened in 2009 when bank customers were defaulting at record rates, you think 2%, 1% or 2% was enough, okay? And so banks had to significantly increase their loan charge-offs and their loan loss allowance, and this impacted their retained earnings and their capital in a very, very big way. All right, let's take a closer look at liabilities. We have deposits. First, demand deposits. Okay, these are checking accounts that do not earn interest. So these are non-interest bearing accounts. It is absolutely the most favorite type of account that a bank has. People put their money there and the banks don't have to pay them for it. Okay? Now accounts, otherwise called negotiable order of withdrawal. Okay? So these are checking accounts that earn interest. Okay? And again, these things had to evolve over 100 years or so in terms of regulations and laws. Okay? Then you have savings deposits. Okay? You have regular savings, and they have minimum balances and different interest rates depending on what kind of account it is. Then you have this thing called automatic savings, okay, where sums are moved from checking into savings. Then an item called a money market deposit account. Please do not confuse this with a money market mutual fund. They are very, very different animals. MMDA just at commercial banks. Okay? So these are checking accounts that have higher yields on them than the regular checking accounts, and they have limited withdrawal privileges. And then you have time deposits, and these earn even higher rates. These are CDs, and they have prepayment penalties. If you cash them out early, you have to pay a penalty. And the maturities range from a short 1 month to all the way up to 5 years. All right. Then we have non-deposit borrowings. We'll start with Fed funds that are purchased. This is when a bank, if they purchase Fed funds, they are borrowing. Okay? Short-term borrowing from other banks to meet reserve requirements. If a bank at the end of the day finds that they are below the amount required to be held on reserve, then they will reach out to other banks and borrow. Okay? Then you have securities sold under agreement to repurchase. Okay? So this is, again, just another type of Fed funds. Okay? So you sell a security, usually a treasury, with an agreement to buy it back. So you're using your security as collateral, basically. Okay? Then this item called acceptances outstanding. This is an interesting concept. Acceptances outstanding. Okay? It is similar to a post-dated check. All right? It is a promise by a bank to pay an amount at a point in time that is written against a customer deposit. So the bank is guaranteeing, okay, payment for a customer that has the amount money on deposit. Okay, so it is a guaranteed payment. All right, and so the bank could be obligated to make that payment. So it is a liability. Okay. The holder of the acceptance, okay, is going to get paid. So they have a piece of paper that says the bank will pay this amount at some point, and so the holder could sell that acceptance. It's worth something. Okay, it's an IOU. All right. Then we have euro currency borrowing, and again, this is only at the big banks. All right. And this is for banks that accept deposits in a currency outside of the resident country. So this is only for big banks, and they will accept deposits in euros or in yen. Okay. Then you have subordinated debt. These are unsecured bonds. Okay. So they're behind senior debt if bankruptcy occurs. So banks typically issue a great number of bonds in order to raise cash, which they then use to fund loans. Okay? The credit rating on these subordinated bonds is lower than on senior bonds because they are farther behind in terms of the order of payoff if bankruptcy happens, and their interest rate is higher. Okay. Then we have what's called limited life preferred stock. Okay. So this is an equity security that pays a dividend that is ahead of common equity. Okay, in the event of a bankruptcy. So if the firm goes bankrupt, the holder of a limited life preferred stock will get paid back before common equity. Okay. But it is redeemable on a certain date by the holder. So this is kind of, it's a bond, which is what a preferred stock is. It's a type of bond that is somewhere between a bond and a common stock in the event of a bankruptcy. All right? So a lot of these trust preferred stocks are out there in the marketplace. Why do people buy them? Because they're safer than common stock, and they pay a yield that is higher than the common stock, but probably not quite as high as the bonds. All right, let's take a quick look at the equity capital of banks. Preferred stock, okay, as we just said, like bonds, they pay a fixed amount periodically. The dividends are not deductible for tax purposes, okay? Like stocks, they have no redemption or price date, so this is how a regular preferred stock is different from a limited life preferred stock. A limited life preferred stock will be redeemed. Okay? Then you have common stock. Okay? We're all familiar with that, so I'm not going to spend too much time talking about that. Then you have what's called capital surplus or retained earnings. Same thing. Capital surplus or retained earnings. Profits generated that are not paid out to investors. Okay? Your common stock and your surplus represent the margin of safety that depositors and borrowers have in the event that the bank sustains losses. And again, we'll talk about this in more detail. Banks are highly leveraged, which means they have a lot of liabilities compared to their assets. And so they don't have quite as much of a margin of safety, and this is why banks are so highly regulated. Okay? A small write-down in assets can wipe out their equity. All right, then you have treasury stock, and this is when the bank repurchases stock from the market. Then you have a contingency reserve, which is an amount set aside to guard against a potential loss. Okay? And I really don't know why they threw that in there, because all banks have plenty of reserves. All right, let's take a quick look at the liability side, and then we'll take another quick break. All right, so we have percentage of total assets for all banks, small banks, mid-sized banks, and large banks. And so you can see total deposits range from 84% for small banks to 69% for really large banks. Okay? Interest-bearing deposits range from 70% to 55%. Okay? So you can see that the large banks, they fund in ways that are different than small banks do. Okay? And so here's how they fund. Other borrowed funds, subordinated debt. So this is where the large banks come into play, much more so than the smaller banks. And you can see Fed funds, again, it's the larger banks. You can see that total equity capital right around 11%. The mid-sized banks, at least at this point in time, had a smaller amount invested in equity capital. And you can see that most of that equity capital is your retained earnings. Your retained earnings. Surplus and undivided profits. Those go back to English, the old English days. That's retained earnings. So most of the equity capital comes from retained earnings. So the biggies, once again, deposits, and most of those deposits are interest-bearing. Okay? The vast majority is in deposits, and then you have your retained earnings. All right, we're going to take a quick break. We'll come back for the last section of chapter 5. Peace out. Shalom.